The tax code contains hidden loopholes and expert strategies that, when used correctly, could legally slash your tax bill. Are you unknowingly donating a fortune to the IRS? Discover the secrets to reclaiming your financial freedom today. Let's break down how taxes work. There are several types, but we'll focus on income, capital gains, and sales taxes. First, let's talk about income tax. This is a tax on the money you earn, whether it's from your wages, salary, or even some investments. The more money you make, generally, the more tax you pay. It works using tax brackets, which are ranges of income that are taxed at certain rates. For example, the first certain amount of income might be taxed at 10%, the next portion at 12%, and so on. Understanding your tax bracket is vital for effective financial planning. Remember that you only pay the higher rate on the income that falls within that specific bracket. Taxable income is not same as gross income. Taxable income is income after deductions. Standard deduction reduces your taxable income. Now, let's move on to capital gains taxes. These taxes apply when you sell an investment, like stocks or real estate, for a profit. If you hold the asset for more than a year, it's usually taxed at a lower long-term capital gains rate. However, if you sell it within a year, it's taxed at your ordinary income tax rate, known as a short-term capital gains. Calculating your cost basis, or what you originally paid for the asset, is crucial for figuring out your profit or loss. Accurate record keeping is essential here, especially if you're actively trading stocks or dealing with real estate. Understanding the holding period can help minimize your tax liability. Capital assets is crucial here, so keep this in mind. Finally, let's discuss sales tax. This is a tax on goods and services you buy at retail. The tax rate varies by state and sometimes even by city or county. Sales tax is a consumption tax, meaning you pay it on what you spend. Businesses that sell goods online also have to collect sales tax, so know the rules regarding Nexus if you run business. It's also important to claim deductions. Deductions reduce the amount of income that is subject to tax, resulting in a lower tax liability. Tax credits, unlike deductions, directly reduce the amount of tax you owe. There are various tax credits available for education, childcare, and energy efficiency, among others. Claiming the eligible tax credits can substantially lower your tax burden. For those running a small business, understanding eligible deductions can significantly reduce your tax liability. Keep detailed records of all business expenses, including travel, supplies, and advertising, to maximize your deductions. While this video covers the basics, the world of taxes is vast and complex. We haven't delved into topics like state and local taxes in detail, nor explored advanced strategies such as 1031 exchanges for real estate investors or tax-advantaged accounts for long-term savings. Also, the impact of potential tax reform on these areas warrants further exploration. If you found this guide helpful, give us a like, share, and subscribe to keep watching for more financial insights